Welcome to Market Catalysts, everyone. I'm Brad Smith. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts that we're watching this hour. First up, we break down the biggest trades of the first half of the year and bring you the trades to watch in the back half of 2025. Plus, Bitcoin's record rally leaving some other crypto names in the dust. We take a look at the moves and Wall Street's push into stablecoins. And we break down what to expect from Tesla's deliveries data this week as the automaker faces some PR pressure from Musk's role in the White House. All that and much more coming up. Let's get a check-in on the markets, beginning things as we always do. 30 minutes into the trading session, the Dow is higher by about 0.4% right now. S&P 500 has already seen some fresh record highs to close out the first half of the year, the second quarter of the year, and we will see exactly where we end today's trading session as well. The Nasdaq Composite, you're seeing that higher as well by about 0.2%. We flipped on over to the 5, the 10, and the 30-year yields. You see a little bit of retreat, a little give back here on the day. Just a couple basis points here as we're tracking the 5, the 10, and the 30-year, all moving lower as of right now. Let's go live to the Nasdaq to take a look at some of the biggest movers that we've seen in the first half of the year. Joining us now, we've got Yahoo Finance's Ali Canal. There she is. Ali, what are you watching here?
Hi, Robert. As you were just saying, we're continuing to see those gains there, particularly when we look at the S&P 500 and the Nasdaq. We saw both of those indexes hit a record on Friday, and if these gains hold, we could see yet another record today. But I do want to call out some of the best performing stocks of the year here. Let's start with Palantir, up over 80%. This has quickly become one of the go-to AI plays on the street. We are about $10 below that 52-week high, so potentially some more room to run here. I also want to give a shout out to Super Micro Computer. This is one company that's faced its share of ups and downs, dealt with a lot of short squeezes, particularly in April. It was actually the most shorted S&P 500 stock for that month, and today we're on track for gains of over 60% since the start of the year. And then can't check out these names without a mention of NVIDIA, up over 16% year to date. So we're just seeing a lot of momentum chasing in this market, a bit of a FOMO rally, particularly when it comes to those AI tech plays. We have seen some diversification, especially when we look at financials, which have been performing well, but still it remains a very top-heavy market driven by some of these big mega cap stocks. So that just highlights some of the risks that we could potentially see to this rally, and that's outside of all the economic noise and trade volatility that could play out throughout the summer here. But for now, we continue to trade at those records, Brad.
Ali, thank you so much. Teeing up today's trading activity here that we're continuing to watch. Joining me now for the next 2 hours, we've got Kenny Polcari, who is the Slatestone Wealth Chief Market Strategist and host of the Trader Talk podcast. Kenny, great to have you here on set with us.
It's always a pleasure to have you.
So we're closing out an extremely volatile first half of the year today. As we look towards the back half of 2025, what is kind of on your checklist for traders going into the start of the second half?
Well, so I think you have to be worried about, we're going to end at the highs today, right? It's going to be a great first half of the year. But I think as we go through the summer, you have to expect some volatility and pullback as we still make our way through this big, beautiful bill and what happens or not with that. Mm-hmm. What happens with Jay Powell? We're going to get a July rate cut or we're going to get a September rate cut. Certainly not one in August because there's no meeting. They got the Jackson Hole boondoggle, and we can talk about that as well. But then I think that we come into a seasonally weak time of year, August and September, that nobody should be surprised at, with a rally at the end of the year taking us back to probably right in here near the highs. 6,200-ish.
What do you think are the trades that ultimately lead that? Is there one sector that looks like it's poised to outperform and continue to thrust us further through these highs?
Listen, I think it's going to be AI. I think it's going to be that whole sector, the whole tech sector, but specifically what's going on in AI is going to lead this market higher this year, next year, and I think quite honestly the year after. It's very much in its infancy stages, and so I think it's got a lot of room to run, and so I think it's going to be one of the key drivers for the total market.
What happens if we don't see more breadth come into the market?
Well, that always gets a little bit anxious if you don't see the broader market participating, right? Then you always get sectors that are way overdone where the broader market's lagging, and then you get a correction. Mm-hmm. I don't think that's going to be the case. So I think we've seen broad participation. Look, the industrials are up 11.5% this year. Utilities are up 8%. You have a number of 6 or 7 sectors of the 11 major sectors that are actually in positive territory and doing better than even the averages. So quite honestly, it feels to me like it's very broad.
And so as we get into July, of course, that's going to come with the kickoff of the next earnings season. What do you anticipate that we're going to hear in terms of the changing of tenor, if at all, from some of the executives that are going to be talking and have been talking at length about the tariff considerations that they've had to.
Well, it's going to be very interesting because it kicks off with the banks, right? JP Morgan, which is the first Dow stock, it's the official kickoff of the season. But Jamie Dimon has been very vocal in terms of what he thinks and where he thinks the market's going and what he thinks we should be concerned about in terms of the Fed, the deficit, and really what the economy is going to do. So it's going to be curious to hear how JP Morgan comes out, how they perform. I like JP Morgan. We own it. I own it. It's a fan favorite. But I always pay attention to what he says. I do recognize, though, that he tends to be a little bit more bearish and cautious than some of the other ones, right? Brian from Bank of America, we're going to hear what Brian Moynihan says. Citibank, we'll hear what they all say. But that's going to be the kickoff of that whole season. It's going to set the tone for what I think we're going to hear from the rest of them.
Is the key to watch from them how they're thinking about the average effective tariff rate?
I think that yes, but I think that's less and less important. I think people are getting used to the fact that the tariffs are not going to be this disaster that everyone thought they were going to be, in April when they first announced them. And as we start to get deals and we recognize that it's not going to be that bad, I think that part of the conversation is going to end up fading. That's not what I'm worried about.
Yeah, well, it seems like the markets are not as worried about that as we were in April as well. Taking a look at that chart a moment again where it's more like a rear view mirror. Did you see that crap? So, Kenny, stick with us. We've got much more to discuss. Coming up on the other side of this break, a marathon vote is underway in the Senate. Republicans race to meet a July 4th deadline for President Trump's tax bill. We've got the latest headlines for you next on Market Catalysts. The Senate's big, beautiful bill narrowly passed a key hurdle this weekend after a marathon session with a final vote expected in the days ahead. Here were some of the biggest changes made to the bill over the weekend. Washington correspondent Ben Worschel. Ben, what were some of those big changes?
Yeah, so as you mentioned, negotiations are continuing and amendments are being voted on right now on the Senate floor. One of the biggest changes policy-wise that we've seen concerns the energy sector. Nobody thought this was going to be a bill that was friendly to clean energy. The debate essentially up until last week was not whether to eliminate Biden-era clean energy credits, essentially how quickly to do it. But what we learned over the weekend, sort of as this bill was being digested and we saw the full Senate text, is not only is the Senate version coming in sort of the most aggressive version of zeroing out these credits. One in particular around EVs would zero out in September of this year if this bill passed as is. But some additional provisions in there that are sort of against the clean energy sector, especially around things like new taxes that would come into place in 2027 for companies that use Chinese parts. So this is not only a kind of less goodies from the government for this clean energy sector, but some additional punitive measures. This combined with some new stuff that's pro-fossil fuels that really has kind of set off the clean energy community over the weekend. Elon Musk is clearly the loudest voice in that. He had a flurry of tweets over the weekend lambasting this, saying you were basically funding the industries of the past and undercutting energy of the future. And I suspect this is going to be something that is going to take a while to digest, and we're going to hear a lot about, especially if this passes in the coming days. This impacts everything from utility prices to AI growth and a whole bunch of factors as the Senate continues their process here.
And Ben, those changes have left lawmakers with a bill that would add nearly $3.3 trillion to the U.S. debt over the next 10 years, according to CBO estimates. So how does that compare to the House version?
Yeah, so this was the other kind of major development we saw this weekend, this new Congressional Budget Office estimate of at least $3.3 trillion in the bill. This is almost $900 billion more than what was in the House version. This comes after a variety of changes across a bunch of fronts. The two major ones would be SALT. There's a kind of more generous SALT provision that went in there. That costs a lot of money. A lot of changes like that are coming in there. And so this kind of underlines this price tag issue that we're coming into. The Senate just is debating right now whether to use this policy baseline that hides a lot of these costs. But the bottom line here is we're seeing at least $3.3 trillion in price tag. A lot of estimates are even higher if you consider interest cost, if you consider making some of these last minute changes, what they could affect. The price tag is going to be over $4 trillion, at least economists project. The White House says economic growth will overcome that, and Scott Bessent just affirmed in the last hour that he's he's confident this is going to reach the president's desk by July 4th. But this price tag is going to be another big issue we're going to be talking about for a long time.
Ben, thanks so much. Teeing up our next conversation. Appreciate it. And the voterama has begun. Senators are in a marathon session known as a voterama to vote on amendments to President Trump's major tax bill. They're racing against the White House's self-imposed Friday deadline. Here with what investors should watch for in today's session, Henrietta Treyz, who is the Vita Partners managing partner and director of economic policy. Great to have you as always here. So what's kind of chief most on your checklist that needs to come forward, at least in the discussions in the voterama today, and ultimately how investors should be thinking about that?
The most important thing is the amendment or the motion that they are considering about whether or not to sidestep the parliamentarian and use the current policy baseline that Ben was just talking about. Effectively, what we're doing here is we're authorizing $3.8 trillion in deficit increases without paying for it, and moreover, assuming that the cost is zero. And the reason that's important is mostly for the bond markets and anybody looking at our go-forward debt and deficits. That effectively paves the road, a beautiful road for steamrolling through any further deficit increases that any party wants from now on. So this is like sort of the end of any sort of leash on deficit increases or spending from Congress. So that's a very big deal. Other than that, the Medicaid cuts are enormous for the hospitals. Hospitals nationwide are sort of freaking out. You can see that in the market today, and also the energy stocks as the IRA tax cuts are being repealed to a much greater extent than I think anybody anticipated, certainly us.
I mean, we had some of these projections going into the prior bond auctions just a few weeks ago. Why was it that there wasn't that much of a difference, perhaps, and the demand still seemed to remain strong, even if we did have those projections? And now what could it signal for future bond auctions?
Yeah, I think it's really interesting. So the bond markets and our investors that are our clients that are mostly bond focused really started paying attention to the current policy baseline in this brand new dynamic, a new era in federal spending about 6 months ago. And I think they were way ahead of the curve and really started pricing in. And we saw that in some of the auctions in the last couple of months and the freak out in the bond market earlier this year. And that sort of has acclimated to this idea. But I think as it seeps into the average retail investor, and we see it particularly coupled with the incoming inflation data, whether it's transitory or not, we're collecting this revenue from somewhere. Consumer prices are rising, and the consumer is not getting a tremendous amount of feedback from this tax bill. It's much smaller than any of the offsets that you'll get from the tariffs. So I think the auctions issue is definitely what keeps cheap economists up at night.
That's a major question that we've been continuing to try and wade through, is whether or not the elements of the tax bill would be paid for by the tariffs, as the Trump administration has been talking about, especially as we're getting some of the thinking around the average effective tariff rate going forward from here. Is that the case where we would see the tariffs essentially pay off the tax bill?
Well, let's do some of the math here and think about what the tariffs are. The tariffs are obviously a tax on a U.S. consumer. So those tariffs are generating something in the range of about $400 billion to the U.S. Treasury that's being collected by the consumer that pays for it. Then if you think about what this tax bill offers in terms of new stimulus to the U.S. consumer, it's $166 billion worth of new spend. Everything else is just an extension of the status quo. So this new spend for individuals is on, no taxes on tips, no taxes on overtime, and limited taxes on retirement earnings. That is obviously not an even offset. So you're collecting $400 billion from the U.S. consumer, and over 3 years, you're spending $166 billion on them. So this is a net loser for the U.S. consumer.
As we're thinking about the consumer right now, we've seen some somewhat resilient inflation data, even though we were at, 2-handle to start off the year. As we're thinking about when some of the tariff policy is set to show up in the data, what should we be most notably looking out for there, especially knowing that that's what's also been keeping a lot of the senators and congressional members up at night trying to figure out how their constituents are being impacted?
Yeah, think about the timing of this. We need this tax bill to pass now so that the president has as much authority or leeway as he can have going into the July 9th expiration of his 90-day suspension. So what I think is coming is an escalation in sector-specific tariffs, and that would be across semiconductors, pharmaceuticals, timber, lumber, copper. airliners, a whole bunch of other components like that, trucking. So those tariff rates are going to rise, starting probably, or I hope, at 25%, and then potentially escalating from there on a global basis. But then also we need to factor in that any optimism around going to zero on tariffs was overblown. There is no scenario where these tariffs are eliminated or go to zero in my mind. And if you're going to talk about the $400 billion in revenue that you're generating to pay for this tax bill, you have to keep the tariffs in place. You certainly can't take them off. I think the risk of tariffs rising on certain nations on July 9th is very real. Most exposed is Vietnam, Indonesia, Malaysia, that contingent. But we could also see it across the EU, for example. We'll deal with China in August, and it looks like Canada is buying itself through July 21st. So we're basically kicking the can on all of this. The tariffs are going to remain in effect. They'll remain a permanent headwind for the U.S. consumer. They will rise on a sectoral basis, and I don't think any of them are coming off.
And so it doesn't sound like you're anticipating any type of negotiations to net out on a deal prior to the extension or the pause that's been in effect.
Not net out a deal that reduces tariffs or gets them taken off, which I think is what the investment community was sold. We're putting tariffs on to ultimately get them to zero. That's not in the cards. Secretary Lutnick has been very clear about that. When Scott Bessent talks about the revenue coming in, the flow is too great. They cannot take the tariffs off. Otherwise, they'll lose that revenue stream, and the tax bill will become even more expensive. The deficit will rise even further. So we're effectively paying for the tax bill with tax hikes on U.S. consumers.
And so on the trade policy front, what is the kind of making or the thinking around a good deal? What does that checklist look like in your mind?
Yeah, it's really expansive. I think what we really need to be mindful of is on our really big trading partners. The EU is a good example. The list of issues we have is, a mile long, and it ranges on everything from the imports of automobiles and automobile parts, which we're already tariffing at 25%, and they could easily rise. And that's on top of steel and aluminum tariffs. But we also have issues with their digital services tax. And at the core of it is we want them to take our vaccinated poultry, and they don't want it. And that's been an issue that the U.S. and the EU have been fighting about for a century, more than that.
What is the then follow through? Say we do see deals start to come through, and with our trading partners, as we're kind of eyeing up, as you were mentioning a moment ago, in the case of the U.S. and UK, it was immediately brought up even in the press conference thereafter that, okay, there are parts of this deal that you're announcing, but there's not a purchasing appetite, and there hasn't been in the past for certain products, whether it be poultry or some of the others that they listed out in that press conference. So what does the policing and the follow through of a deal actually look like thereafter?
Yeah, great question. I mean, and we have to consider, what is the UK's benefit here? They have to negotiate a trade deal with the European Union. So they can't accept our lower phytosanitary standards on any of those agricultural exports and still do trade with the EU. So it's not in their best interest to reach a comprehensive lower deal with the United States because they have a larger trading partner. And then the other component here, and I'm glad you bring up the UK, is it's a perfect example of having reached a deal and all the tariffs are still on. They might be on at preferential rates in some instances, 10% versus 25 instead of 50. But all the tariffs are still on. So I think everybody just needs to adjust and accept the fact that the president really likes tariffs. They are here to stay. They are on, and they're more likely to rise, especially on a sectoral basis, than they are to fall below the 10% threshold that they're at today.
Henrietta, good to grab some time with you as always. Thanks so much for the insights and analysis.
Thanks for having me.
We've got all your markets action straight ahead. Stay tuned. You're watching Market Catalysts. Now time for some of today's trending tickers. We are watching Home Depot, Oracle, and Circle. First up, Home Depot is making a big acquisition in an effort to attract more industry pros to its stores. The home improvement retailer acquiring building materials distributor GMS for $4.3 billion. GMS shares jumping on the news while Home Depot pretty much flat right now, just barely to the downside fractionally. Still joining me on this, we've got Kenny Polcari, Slatestone Wealth Chief Market Strategist here. Good acquisition for Home Depot?
Listen, I think it's a great acquisition for Home Depot because, to your point, it brings them more into getting professionals to come in and use Home Depot and use Home Depot as a source. So I think it's a great acquisition for Home Depot, and clearly the market likes it because GMS has certainly traded higher, and they're not killing Home Depot, right? If they were really negative about it, they'd be selling Home Depot, but they're really not. Home Depot, as you said, is flat.
Yeah, as we were taking a look at some of the details of this specific deal going forward here, they acquired, of course, SRS as a platform for growth, and SRS continues to demonstrate exceptional execution, strong performance. That from Ted Decker, who is the chair, president, and CEO of Home Depot, which is really kind of the core behind what this company is looking to move forward with, and with GMS as well, accelerating that SRS vision, becoming a leading multi-category building materials distributor, and adding this new vertical. It's adjacent to its existing business that it acquired in 2020.
I think they do a good job. I think Home Depot is a great stock. Certainly, it's been a great stock. I think it's a great store. You can find almost anything there in terms of do-it-yourself, home improvement, that kind of stuff. And so I think this just adds to their bottom line.
They just need to add $1.50 hot dogs, and then
$1.50 hot dogs
regularly, right? And also, we're tracking Oracle shares here today, popping, trading near a new intraday high after announcing it signed a major cloud service deal worth more than $30 billion a year. Oracle also getting an upgrade at Stifel to a buy from hold, saying that its accelerated cloud demand is sustainable and should lead to revenue increases in the coming years. Shares of Oracle up by about 5.4%. We've really heard this company talk about everything from nuclear reactors for energy to power data centers, and then all the way into how they are leveraging this moment of agentic AI, and then additionally just back into making sure that they're entrenching the companies that they've acquired to grow over the years, even more so right now among their portfolio clients.
Right. I think Oracle is one of those key names in that space that investors really need to consider holding, right, as part of whether they hold it as part of an ETF or whether they hold it as an individual name. But Oracle has been a great company. It sits right there at the heart of it. And all this agentic AI, to your point, is going to be part of the future conversation for years to come. So I think it's a great deal for Oracle.
Finally here, let's talk a little Circle on the day. Circle is higher today. This after closing Friday down by over 15%. The stock, though, has been on a roller coaster ride since its debut just a few weeks ago. Several banks initiating coverage on Circle today. You got analysts at Barclays, Bernstein, Canaccord, and Needham all covering the stablecoin issuer with buy ratings and price targets above $200 a share. That represents some significant upside from this point here as we're trading at about 185 pops. And then taking a look at what we're seeing on the move here today as they're up by about 2.5%. I mean, Circle, it really has reinvigorated a lot of the talk around what we could potentially see in demand for IPOs and public market debuts.
Right, and as well as cryptocurrencies, right? And kind of that what's happening in that whole space. But yes, it's been a great name. It's absolutely exploded from where it's been. And so these calls for 200 plus prices, I think, are very realistic, especially in that space. Once again, it's a very exciting space. We're very much into its infancy. And so I think there's room to run there.
Absolutely. Circle shares moving higher here on the day, and you can scan the QR code below to keep tracking Circle and some of the other best and worst performing stocks with Yahoo Finance's trending tickers page. Well, Bitcoin has been on a tear in 2025, up nearly 15% and notching all-time highs. But comparatively, altcoins, they have lagged, with the market vector Digital Asset 100 small cap index showing over $300 billion of market value wiped out. For more, I want to bring in Noel Acheson, who is the author of Crypto is Macro Now, Substack. Great to have you here with us. So first, just take us into your assessment of why altcoins are seeing this move while Bitcoin is notching new record highs over the course of the year.
To be with you, Brad. Thanks for having me. It's still Bitcoin's market. That's the simple answer. And what I mean by that is we're still early in the cycle. Generally, in the various crypto cycles, you have the concentration of activity in Bitcoin to start with because it's the relatively safe on-ramp, and relatively is doing a lot of lifting here, I know. It's the relatively safe on-ramp. It's the most liquid. It's the oldest. It's the most tested. It's the most widely held, et cetera, et cetera. Then when investors get more comfortable with the risk, they go further out on the risk curve, and that's when we start to see altcoins outperform. We're not there yet. The focus is still on the macro story, that's a Bitcoin play, and on the store of value story, that's also a Bitcoin play.
And so as we're thinking through what needs to happen for Bitcoin in order for us to look at the momentum that we've already seen in terms of the movement in Washington, D.C., and then additionally in some of the corporate ranks who are cozying up to crypto or digital currencies, even more so, how does Bitcoin capitalize further on this and hit some of the astronomical targets that have been set by those who are most bullish on the currency?
Well, strangely enough, some of those astronomical targets actually have been hit, much to many of our surprise. Bitcoin is not really affected by the same story that is driving Circle's share price, for instance. Bitcoin is a longer-term play, and it started when the ETFs were approved over a year ago. It started with the education and the institutional adoption, not just in the US, but around the world. Then again, there is a different story, which you were just talking about, which is stablecoins, very different driver there. They benefit from overall activity, not just the narratives driving some of the marketplace, such as Bitcoin at the moment. Very different stories, very different things going on. The Genius stablecoin bill, which looks like it's going to pass sometime soon, that's an overall ecosystem boost rather than affecting directly Bitcoin.
So what is more significant? The fact that you have central banks around the world that are starting to mull over the reality of a central bank issued digital currency or stablecoin versus some of the private companies and banking institutions like a JP Morgan that are trying to figure out ways to offer this to their clients and even some of the card transaction processors as well. I think I saw some news from MasterCard recently on the same effort.
I love that you asked that question, Brad, because it gets to what I think is the most interesting story behind stablecoins, be they the CBDCs, be they the stablecoin acts that are being passed, again, not just in the US, but in many other jurisdictions as well. And that is a redefinition of what we understand money to be. Money traditionally has been issued by, or issued and guaranteed ultimately by central banks. It is a fairly stable value. Stablecoins, although they have stable in the name, they're not quite that. They're private money and they're not always stable in value. And yet, we are treating them as money. We are looking at a new type of money emerging into the market, which is why you're seeing such interest from the traditional guardians of the financial order.
And so what does that mean for the other legacy cryptocurrencies, Bitcoin, Ethereum, and potentially, even some of the majors that have been able to attract fanfare on the coattails of Bitcoin and Ethereum that have really been looked at as and transitioned now from utilization and that thought process to now just store of value?
The easy answer is they're not really related, but they actually are related. If you lift the hood, you'll see that most stablecoin activity is used in the settlement of crypto trading. That's its number one use at the moment. And the more stablecoins that are sloshing around the system, the easier it is going to be for many of the traditional players to efficiently trade crypto. Now, it's not necessary. There are many fiat on and off ramps these days, but stablecoins are a better settlement instrument for crypto trading. So the more stablecoins, the more acceptance, the more liquidity in crypto markets, which should, all else being equal, have an impact on price. But the underlying narratives, again, are very different. Bitcoin is a macro asset, very risk sensitive. It is also a store of value longer term. ETH has a whole different set of narratives going on, so does Sol. But stable coins are, if you like, the plumbing. That's probably a very hand-wavy word, but they are what makes the crypto ecosystem run, while at the same time redefining payments, redefining traditional settlement, and redefining bank services.
Noelle, thanks so much for taking the time here with us today. Really appreciate it.
Great to be with you.
We've got all your markets action straight ahead. Stay tuned. You're watching Market Catalysts. You're looking at video of Tesla's first fully autonomous delivery of a car. This is a Model Y driving itself from the Gigafactory in Texas to its new owner's home about 30 minutes away. Tesla is in focus this week ahead of its second quarter sales results. Current consensus shows deliveries falling 12% from a year ago, but that figure would be 16% above its first quarter numbers. The company contending with continued demand weakness and brand issues surrounding CEO Elon Musk's time working for Doge under President Trump here. And so as we're considering where these estimates could potentially come in at, one of the huge considerations as well going forward is just the appetite as well for car purchases. And this was something that actually stood out in the most recent Consumer Confidence Index data as well from the Conference Board, as auto purchases were one of the areas that consumers were clearly more pensive about making that purchase decision right now. However, compare that to earlier in the year where we were tracking very closely some of the marketing efforts around companies who were saying that, oh yeah, these prices are tariff-free, and so thus trying to spur some demand there. But going forward from here, the larger consideration that investors might have for Tesla is not just the prices that consumers are willing to clearly opt in for an EV at, but more long term, perhaps, what they also might need to be able to see in terms of new vehicles that come forward from Tesla. There's supposed to be another mass market vehicle that Tesla is set to unveil this after its robo-taxi event, and ultimately has started to get some data as well as some of the initial allegations that have come forward around some of the tests that have taken place within that specific area. And so as we're looking through all of the test drives that do take place, autonomous vehicles delivering themselves at home, and then additionally the robo-taxi in the early phases in certain cities. Of course, remember, California and Texas were key to what Elon Musk was mentioning at the beginning of the year. And so delivery on that plus a new mass market vehicle are at the top of the checklist here for Tesla investors. Shares jumped on the back of that event where they ultimately did kick off some of the robo-taxi driving. However, going forward from here, they do face still some stiff competition in the form of Google's Waymo and, perhaps some other car companies that could hop into the mix in the future, and ride-hailing companies like Uber and Lyft, who have all talked about how that can bring down their operating cost per mile, even since they've been going public. So all that considered, we're keeping close tabs on shares of Tesla and self-delivering cars here in the future. And investors are watching the auto sector for monthly sales figures expected to clock in at 15.3 million vehicles. That's down from the prior month. We'll also get sales figures from Tesla and Ford, among other automakers. Here with what we're watching in the auto space, we've got Brian Moody, Kelley Blue Book executive editor. Always a great pleasure to grab some time with you. So
thanks.
As you're thinking through what we're anticipating here for U.S. vehicle sales, in the backdrop of a lot of consumers' minds is, do I feel comfortable making such a big ticket purchase right now? What are you seeing play out in the data and anticipating here?
Right. And it's clear that people are thinking about that. They're thinking about tariff-related impacts on the prices of cars. And the reason we know that is because we saw a rapid uptick in terms of car purchases in April, presumably from people trying to beat any kind of tariff price increases. It's leveled out somewhat now, but we're still in growth mode in terms of for June. The growth has slowed, though. So those two things are different. It's not that sales are slowing, it's that it's still growing, but the growth itself has slowed somewhat. That could be good news for consumers because that might mean the return of some attractive incentives, but we don't know that for sure yet.
Is it clear what type of vehicle, whether that be EV versus the standard combustion engine type of vehicle, that a lot of consumers are still gravitating towards right now?
Well, yes. Consumers are definitely gravitating toward the same type of vehicle they've been for the past several years, which are small SUVs. So think about a vehicle like the Nissan Rogue, which, by the way, has a price reduction because it's made in the U.S., and then there's also vehicles like the Honda CR-V, Toyota RAV4. Those types of vehicles are the kinds that consumers have shown that they really want. Usually that means no incentives because there's high demand. However, there's more than 25 different choices in that category as automakers rush to fulfill the demand, so you may find some incentives. Here's the hard part for shoppers. You can't write off one whole brand in terms of price reductions or price increases. You have to go searching model by model to find out that information on almost a weekly basis.
As we're thinking about purchasing plans for cars, and I want to correct myself from earlier from the conference, Consumer Confidence Index, Conference Board's Consumer Confidence Index, purchasing plans for cars were steady, highest level since December 2024. But you had mentioned, as we had really tried to give a lot of context around the undulations that we've seen as well. And so as we're looking for stabilization within the car purchasing patterns, is it clear right now where consumers are comfortable at a certain price point and where they're starting to push back?
Well, they are starting to push back because we see more of those small SUVs transacting, and those are happening at a lower price. Also, we see automakers introducing those types of vehicles. The Nissan Kick's a great example, at a lower price. So what's happening is APR can't go up with prices going up at the same time. There's too much pressure for those two things to coexist. So one thing will have to give. The weirdest part of this is that you might see an announced price increase on a certain model, while at the same time the manufacturer turns around and offers low APR financing. That could be a thing that we see in the future. So doing research is crucial.
One of the things that we've also been tracking from the auto manufacturers, especially here in the U.S., is more of a commitment to manufacturing in the U.S. in order to make sure that they can maintain the mind share of the consumer and also the good graces of the current administration as well. And so as we're thinking through both of those factors, which one is positioning themselves best for a long tail or perhaps a larger cycle of consumers who are continuing to kind of gravitate towards their offerings?
Well, the automakers who already build many of their cars in the US are in the best position to weather this storm. And there are many of those automakers. Typically, vehicles you think of as being, quote, import brands already build plenty of vehicles here in the US. Volvo, Mercedes-Benz, Toyota, Nissan, Honda, all of those we typically thought of as import brands, they make plenty of cars here in the US. Here's why they're in a good spot. When they make the cars here in the US, Mercedes-Benz has already said they're going to do this. They have the capacity to ramp up in-country production of a car that may have been manufactured overseas. When they have that capacity, that's a good sign because it means that they can avoid some of those tariffs and keep their prices steady and appeal to their consumers on multiple levels.
Brian, thanks so much for taking the time here with us today.
Yep, thank you.
We've got all your markets action ahead. Stay tuned. You're watching Market Catalysts. Gold hovering below $3,300 an ounce as stocks hit new highs as optimistic investors flock to equities over safe havens. For more on gold's moves so far in 2025 and what the second half of 2025 could mean for the metal, I'm joined by senior markets reporter Inez Ferre. You've been tracking this one, Inez. What have you found?
Yeah, Brad, and gold is up 24% year to date. So it has still outperformed the S&P 500. It is still an asset which Wall Street is bullish on. Now, there are two views when it comes to where gold is going to go next, because we have seen, I'm just going to show you on our Wi-Fi Interactive, we've seen a little bit of a pullback in recent weeks. And part of this has to do with the fact that geopolitical tensions have eased. And there's also been some progress, of course, when it comes to the trade deals. So therefore, you're seeing that pullback in gold prices. But I'm going to give you two views here. And one is from Goldman Sachs. Goldman Sachs believes that gold prices will go to 3,700 by the end of the year. That would be a record high. And in mid-2026, 4,000. And the reason why is they're saying that structurally, you still have strong demand from central banks that have been buying gold. And you also have increasing inflows into ETF holdings. So that is their thesis of why gold is poised to go higher going into the end of the year. Citi, though, projects that prices could drop below 3,000 by the end of the year. And they say that this is because of declining investment demand and you have a better global growth outlook. So as inflation eases, and you have economic fears that are really subsiding, then you have investors that are pulling out of gold and rotating out of those safe haven assets into other assets like equities, for example, which are at all-time highs.
Yeah, indeed. Inez, thanks so much for tracking the commodity and breaking down the correlation as well that we were seeing in some of the mindset in the equity market. Appreciate it.
Thank you.
So Kenny, still here with us, and as we were talking in the break, how are you seeing some of your clients thinking about gold within their portfolios right now?
So look, there's a couple of ways to think about it. I think people should have exposure to gold, no matter what, right? The percentage of it is going to be your own desire.
And there's different ways to do that.
There are different ways to do it. You can buy physical gold, you can have gold ETFs, you can have the gold miners. But one way or the other, while I don't support a Goldman thesis on gold going higher, I actually, in the Citibank thesis, I think we're going to see gold pull back. I don't think it's going back to 3,000, but I think it's going to pull back, especially as the geopolitical tensions ease, the trade tensions ease, and then we're going to see if they pass this big, beautiful bill, then I think that sets up our U.S. economy to do much better. And so there'll be less of that safe haven mentality that you're going to rush into gold because the world was going to blow up. I don't think that's the case at all, which means I think I'm in the camp that I think we're going to see gold pull back, which doesn't mean you sell it, just means maybe you don't add to it anymore at the moment, and let's see how it plays out.
In that pullback, do you think we've established a new support line for gold, knowing the central banks that have bought in during geopolitical tensions internationally and are now just holders?
So if you look at the chart, we're right in between the two trend lines, and I think we're going to find support down I think it's the intermediate-term trend line at 32.97.
Okay.
Right? I think, where are we trading right now in gold?
32.98, it looks like.
Okay, so I think we're sitting right on the trend line, right? I have to go back and look at the chart, but I think that is the trend line. And I think we're going to find, I think that's where it's going to find some support, right? I don't think it's taking off. I think it's just going to kind of churn around this level for a while. But look, if the data suddenly gets really great and inflation is lower and the Fed starts cutting rates, then we could see and everyone's kind of excited about the future, then we could see gold pull back even more.
Gold compared to some of the other precious metals and commodities that investors could look to, if it's not gold, is there a safe second that
silver, platinum, copper would all be names if you want to kind of be in that precious metal space, right? Those would be other areas that you would look to.
Coming up, everyone, and thank you, Kenny. Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. We've got much more. 90 minutes into the start of U.S. trading, I'm Brad Smith. Let's get a check of the markets here as we begin the 11 a.m. hour. We're taking a look at the major averages here on the day, where we've got some new record highs to report for you. The Nasdaq Composite saw one today, as well as the S&P 500 intraday. As we're taking a look at some of the activity that's transpired, we're still holding on to gains of about 0.2%. We'll round that off too for the S&P 500. And then additionally, the Nasdaq Composite still up by about 0.2%. Dow Jones Industrial Average, you're also seeing gains there on the day of about 0.2%. Also want to toggle on over to some of our heat maps that we've got fired up for you here during the session. We'll come back to crypto. Why not? The Nasdaq 100, though, taking a look at some of the activity that we've seen. This is a year to date, so don't adjust your TV screens. But now, here we are, well calibrated to today's intraday activity. And you've got some mixed activity that's actually playing out among the mega cap tech stocks right now. Meta moving to the upside by about 1% as of right now. Year to date, let's take a look at how that's been performing. First half of the year, up by about 26% year to date for Meta platforms. And then also one of the fan favorites that's been lighting up the Yahoo Finance platform over the course of the year, Palantir, PLTR, ticker symbol, and that is holding on to gains year to date of about 81%. So that, no doubt, going to be closing out a solid first half of the year with some undulations, no doubt, but still net higher. And it's up on the day by about 5% right now. You're seeing a little bit of a pullback in some of those other mega cap tech stocks, though. Amazon down 1%. Apple and Alphabet also seeing fractional declines on the day, as well as Nvidia, the poster child of the AI trade. Year to date, though, taking a look at that, it's up by about 17%. Also want to get you some of the sector activity that we are seeing on the day. 11 S&P 500 sectors all dialed up here on our heat map for you. Technology leading the pack right now. That's up 0.6%. However, in the rear, in the caboose, you've got consumer discretionary. That's down right now by about 0.5%. You can see that year-to-date move as well, lower by about 3%. And then just lastly, I'll give you a look at the 30 Dow components here on the day. And we'll put this on an equal view just so you could see how everything is scattering right now. Boeing pulling up the rear right now, and Nike as well, not too far in front of it. But Boeing down by about 1.8%. Leading the pack, though, you got some of your banks, plus Disney, which got a bullish call earlier this morning. Goldman Sachs, JP Morgan, both of those higher, as well as Disney, and those are your top three performers within the Dow right now. Coming up this hour on Market Catalysts. First up, U.S. stocks trading at record highs as the rally powers on. Full market coverage ahead. Plus, we break down the trades to watch as we enter the second half of 2025. And we look at investing in space as Elon Musk lashes out against President Trump's tax bill. What does it mean for SpaceX's government contracts? That coming up during this hour. The Senate is set to vote on the Republican tax bill as President Trump aims to get the bill signed by the 4th of July holiday. But over the weekend, critics spoke out against the bill and several of its key changes, including President Trump's former ally, Tesla CEO and billionaire Elon Musk. In a post on his social media site X on Saturday, Musk wrote, quote, "The latest Senate draft bill will destroy millions of jobs in America and cause immense strategic harm to our country, exclamation point. Utterly insane and destructive. It gives handouts to industries of the past while severely damaging industries of the future." Musk narrowing in on the bill's changes to energy policy, and it cuts tax credits for wind and solar projects while adding credits for coal. Musk also critiquing how much the bill adds to the U.S. deficit, saying it, quote, puts Americans in the fast lane to debt slavery. Meanwhile, President Trump issuing a warning to members of his party via social media as well on Truth Social, the one he owns. Writing, quote, for all cost-cutting Republicans, of which I am one, remember, you still have to get reelected. Don't go too crazy. We will make it all up 10 times, or times 10, with growth more than ever before, end quote. The GOP's so-called big, beautiful tax bill currently includes a defense budget of just over $1 trillion, including the largest ever increase to Space Force funding for an annual total of $40 billion. According to my next guest, one sector that could benefit from an uptick in defense spending, space stocks. I want to bring in Andrew Chanin, who is the Procure AM co-founder and CEO and manager of the UFO ETF. Great to speak with you as always here. And so take us into your thinking around why some of the defense stocks could be ultimately beneficiaries of this additive space spending, if you will.
So, the government likes to work with American defense contractors, and a lot of them happen to have very large space businesses as well. We actually have an ETF UFO that specializes in focusing on space companies, and so we have a mix of pure play space companies and a lot of the large primes in the industry. So your Lockheeds, your L3 Harris, your Raytheons, and so on are ones that might be looking to win some of the budget, but also the Golden Dome is something that looks like it has tremendous potential to bring significant dollars and spending into the space industry specifically.
Okay, so which of these companies from your analysis is best positioned as well on the contracts front to perhaps be able to capitalize on where we've now seen this contentious relationship start to play out between Elon Musk, of course, the former lead of Doge for a limited time, and then additionally President Trump?
So typically when companies are competing for some of these very large contracts, it's difficult for any one company to be the total solution set for what we're trying to develop. And so we've seen the idea of SpaceX linking up with other industry players as well as with Palantir and Anduril potentially to create a consortium group. But then you also have some of these long-lasting aerospace and defense names that we mentioned that have a very strong track record of winning over government contracts. And so to build out something like the Golden Dome, you're going to need a tremendous amount of various solutions. So it's very possible that we might see a very large number of companies, both public and private, certainly expecting companies that are domestic companies, but potentially opening for some foreign solutions as well to team up to try to create a very overwhelming solution for what could be a major threat. So things that help with launch, satellite, sensors, missile detections. These are all areas that we'll need. We'll also need rockets or other types of ways of taking out potential threats from incoming missiles or other types of drone attacks or things like that. So we need a lot of solutions from a lot of different players, and companies that have previous success in winning contracts know the formula, know what to do. And so they might have an interesting position, but make no mistake, we are going to need a tremendous amount of companies to come forward with all different ideas. And I think we need to hear them all out to see how robust of a defense system we can create with Golden Dome here in the United States.
Based on data that you've seen in terms of flows for the UFO ETF that includes a lot of these companies in it, how has interest in investing in space from investors, from traders, looked like this year versus years past?
Yeah, so the UFO ETF has been out since April of 2019. So we've seen a lot of different changes throughout the world during that time period. A year ago, things had kind of been slow in the space industry, and then in early May, things really started to pick up. We started to see some companies that weren't necessarily household names starting to sign some pretty interesting contracts. AST Space Mobile being one of those names that was not in many other ETFs, but ended up becoming one of the largest holdings in UFO towards the end of last year, just from their performance alone. This year, we saw kind of very early excitement into the space industry, and that started tailing off into March, end of February, March, April. And just about a month ago, we started seeing a kind of a resurgence of interest into some of these space names. A lot of the former SPAC names started getting picked up as well, and started seeing some interesting movement as well. And so I think a lot of people are looking at how geopolitics are shaping investment into defense and space. Space is now something that military leaders look at as the strategic high ground for military warfare moving forward. And so it's an area that can't be ignored. And we're seeing countries, companies, militaries, all try to figure out what their role in space will look like and the types of partners that they want to work with. So in Europe, you actually see some of those companies looking inward saying, maybe we don't want to work with the US. And you've got a company like Avio, which is in the fund, which has started getting some interesting traction from Europe, kind of a resurgence there over the last couple of months as well.
And so with that in mind, and you mentioned this to a certain extent, but would love to dive deeper, just the international kind of composition of trade deals and how much of that could also focus in on space, especially coming out of the NATO agreement last week to increase spending.
Yeah, so we heard news come out just in the last 24 hours or so of Iran saying that they're going to ban Starlink. And that's not really anything too shocking or necessarily a huge missed opportunity for Starlink. But you look in Europe and they're saying, hey, maybe we don't want to necessarily work with SpaceX, or we don't want to completely tie ourselves to one company. And they're saying, how can we look within Europe to find solutions? So, if you don't want to work with Starlink, we've seen some groups say, hey, AST Space Mobile is interesting. And they're starting to win over some European contracts as well. The idea of trying to really ramp up Eutelsat, another European communications provider, is another solution that they might be looking for. But if you look at the breakdown of UFO, you'll actually see that there's a decent size exposure to foreign companies. So you're getting exposure to names in Sweden, in the UK, in France, in Japan, in Canada, and so on. So when we talk about space is absolutely a global industry. Yes, many of the leading players happen to be in the US, but as countries are trying to figure out what their space policy and strategy will look like for the next 10, 20, 30 years, a lot of European companies and countries are starting to say, hey, what can we build here? And are looking to try to reward some of those local companies as well.
Yeah, you mentioned AST Space Mobile. It's been an absolutely insane run that we've seen for the stock over the course of June, and AST Space Mobile moving higher by about 100% during the month alone to close out this second quarter of the year. Just lastly, while we have you, the risk that Elon Musk is running into if he does continue to kind of ruffle the feathers of President Trump.
It's tough to say. SpaceX has a lot of leading products. For launch, they're the leading launch provider. They can do all different types of projects, large and small. And so to steer away from SpaceX is potentially going to limit your access to space. In many cases, I think victories for SpaceX have been victories for the broader space economy, because lowering the cost of launch brings a lot more players into the space industry, and clients that possibly wouldn't be able to take the risk or pay those expenses at a higher cost of launch. So, historically, I think SpaceX has been phenomenal for the overall space industry. To the extent that people start looking for other solutions, things might take longer for them to see their space ambitions come through. Things could be more expensive. There's a lot of potential negative aspects to it. But so far, we haven't necessarily seen a major hiccup, and a lot of people that have been working with SpaceX have been very happy to continue working with them as well. So, no matter what happens, SpaceX presently is a major player in space, and I certainly hope to see that continue into the future.
Andrew, thanks so much for taking the time here with us today.
Thank you.
We've got all your markets action straight ahead. Stay tuned. You're watching Market Catalysts. Let's go live to the Nasdaq to take a look at some of the biggest movers that we've seen in the first half of the year. Joining us to break this down, we've got Yahoo Finance's Ali Canal. Hey, Ali.
Hi, Brad. Yes, it's the last trading day of June. We are capping off the first 6 months of the year, and stocks are currently trading at record highs. But I wanted to zone in on some of the sector action to look at some of the top performers and some of the underperformers here. Communication services leading the way higher, up about 12% year to date. Now, this sector includes names like Alphabet, Meta, Netflix, Disney, and many of those companies have performed very well so far in 2025 and are currently outpacing the broader market, particularly Meta there. We have a year-to-date gain gain of 28%, and Netflix is up 50% since the start of the year. And we also have industrials up double digits here. We've seen stocks like GE Aerospace surge over 50%. Boeing is up 20%, and RTX Corp has risen about 25%, helping to lift the overall sector. And then Tech XLK rounds out the top three, obviously helped by Nvidia and Microsoft, which are both up over 15%. And then flipping over to the worst performing sectors, consumer discretionary, it just hasn't been able to do it this year. Some of those biggest laggards in that group include Tesla. Shares are down over 20% there. VF Corp, which is known for brands like Vans and North Face, that stock has plunged nearly 50%. And then we also have shares of Nike, Starbucks, and Amazon all underperforming the broader market. So that's the setup heading into the second half of 2025. Energy and healthcare have also underperformed. We'll see if we can get a bounce back in some of these names, some of these sectors heading into the summer and the fall. But for now, we still have a market that is trading at record highs. However, I will say that a lot of the concentration has been in these high quality mega cap names. So some more diversification, I think, is needed for the back half of the year here, Brad.
Allie, thanks so much for the analysis and the breakdown. Appreciate it. Earlier this morning, Yahoo Finance executive editor Brian Sozzi sat down and spoke with Microsoft AI CEO Mustafa Suleyman on opening bid about AI and healthcare. Microsoft announcing positive results from trials with its AI tech built to help diagnose medical cases. Suleyman talked about how this tech can help the healthcare system overall. Take a listen.
Well, the incredible thing is that we at Microsoft AI already have 50 million health-related queries per day coming through Copilot and Bing. And our goal is to try and provide the most high quality, most accurate, and ultimately the cheapest health advice and support to all of our consumers and to many more in the future. So although this is just early research, we're hoping that as we get this into production, it will give everybody access to very high quality health information.
The first thing I thought of, Mustafa, when I saw this, why do I need my physician? And does the physician over time go away because of these advances in AI?
No, you definitely still need your physician. Your physician is going to be there to make the right judgment call at the right time, to plan the treatment that often comes right after the diagnosis, and essentially to oversee and organize and hold the AI itself accountable. Essentially what these models are doing is that they're looking at the vast array of existing medical information, synthesizing it and presenting it back to the human at the right time. This is an amazing interactive experience. AIs are now actually asking questions of the data themselves, recommending what tests to get, and then iteratively, sequentially improving the accuracy of its diagnosis as it learns more information. And so doing that in partnership with physicians, themselves is clearly going to be the way that this gets rolled out, I think.
How are physicians getting trained in AI?
Well, I mean, today, you have to pass the US MLE, the medical licensing exam, and you need to get about 60% on multiple choice questions. These models get upwards of 95% accuracy on those questions. But the really unique thing about this model is it doesn't just use one AI, it actually uses all four of the big major AI developers and essentially goes to whichever one is most accurate at any given time. And that's what the function of an orchestrator is. It decides when to use a big model or a small model, or when to use lots of thinking time or a little. And it is able to kind of get a much more accurate answer by taking the best of all possible models.
In many cases, healthcare decisions deal with life or death, Mustafa. How do you build trust in this technology?
Well, the cool thing about this method is that you can actually see why the AI is coming to a particular conclusion. And as you add more data, it updates its best estimate of what the diagnosis is likely to be. And so that gives a lot of transparency around how it's thinking, what data it factored in, which tests it does. So this is actually an unprecedented amount of transparency, which of course is key to trust, because you can actually go back and look at the entire conversation that took place between many different agents that are all coordinating with one another to debate on what the most likely diagnosis is going to be. And that, I think, ultimately is the best way to improve trust.
Early this year, Mustafa, I had a chance to talk to Microsoft co-founder Bill Gates. He gave your book, The Coming Wave, a shout out. Compared to when you wrote that book a couple of years ago and today, just given how fast things are moving in AI, are you more or less concerned about the power of AI and risk associated with it?
I think I would say I'm about the same. I think that progress has been phenomenal and things are getting better and better. The models are getting much, much smarter. But I just couldn't be more excited about that, because this is the dream of having models that can help humanity solve our biggest challenges. I think we're going to see the greatest productivity boom in the next 10 years we've ever seen, because after all, intelligence is the thing that invented all the tools and technologies that has improved civilization for many, many centuries now. And we're now about to make that a cheap and abundant resource that everybody can use to invent and be entrepreneurial. And it's not that there aren't risks, it's just that the opportunity is absolutely enormous for everybody. And that's how we should measure technology. Does it always improve the human condition? Does it always elevate humanity and make us smarter and more productive and safer? And that's the test that we should hold it to. So that's why I'm so excited about, the steps that we're taking here towards medical superintelligence. Imagine having the absolute most perfect medical diagnostic superintelligence in your pocket at any given moment. That's the kind of AI that I'm sort of really pursuing, I'm most excited about.
And Mustafa, it's within this research, you did mention that it was utilizing OpenAI's O3 model. And of course, Microsoft and OpenAI have had a really strong relationship since 2019, but reportedly that relationship has begun to fray a bit. From your perch, what is the status of your relationship? I mean, Microsoft has invested, close to $14 billion in OpenAI?
I think the relationship's in pretty good shape. I mean, OpenAI is an incredible company. They're on an explosive path to growth. And, they're their own company doing their own thing. And we've had an amazing relationship for 5 years, and it will continue for at least another 5 years and hopefully many decades after that. So I think it will go down in history as one of the best technology partnerships that there has been. And so, naturally, that's always going to require constant iteration and evolution. So I think it's in great shape.
Are you close to resolving any differences?
Absolutely. I mean, I think it's been an ongoing discussion for a long time now, upwards of 6 months or so, and it's a very complicated contract and, lots of tweaks need to be made. But fundamentally, these are two companies in a great alliance, and I think that's definitely going to continue.
As someone that has been on the ground floor of AI, such as yourself, of course, co-founded DeepMind many years ago, does the switch to for-profit for a company like OpenAI, does that add more risks to society over time as their technology gets even stronger?
Look, I think the good thing about OpenAI and my previous company Inflection, as well as Anthropic, and a lot of efforts that we made at DeepMind, is that all of us founders of these AI companies have started out with asking the question, what is the public benefit? How does this serve humanity? And we've tried to experiment with different legal structures to do that, different incentives for the company itself. But we've definitely put these issues of the ethics and safety of these applications right on the table, front and center, for the last 15 years. And I know that whatever structure OpenAI takes, the team there is going to continue to do that.
And this comes, of course, really the competition for top AI talent is through the roof. I haven't seen something like this before in my time covering the space, Mustafa. Now, Mark Zuckerberg is reportedly willing to hand $100 million paychecks to get the talent he needs. Are you willing to do that in Microsoft to get the talent you need to keep making breakthroughs?
Look, I think the incredible thing about this technology is that it's also widely available in open source, and a lot of the knowledge and know-how is proliferating faster than any other technology in human history. So I wouldn't over-index on, the rumors around the state of play in the labor market today. And I think in actual fact, there's going to be a huge, huge talent pool as everybody adopts this technology over the next few years.
And lastly, we're still thinking back this year to DeepSeek and its impact on AI and the broader stock market. As you look forward, how far is China in the AI race versus the US, or are they not ahead?
No, you've got to take them very seriously. They've always been a very talented group of researchers. They've found their way around getting access to computation. They probably have slightly looser controls when it comes to accessing data, which always frustrates me. But we take them very seriously as a very credible AI development team.
All right, we'll leave it there. Good to see that research out this morning and what you're doing in the healthcare space. Microsoft AI CEO Mustafa Suleyman. We'll talk to you soon.
Thank you. Good to see you.
Appreciate it.
Got Kenny Polcari here on set with me, and as we were talking in the previous break, just the thinking around the broader AI trade, and it's got so many different ways that investors can get exposure right now. What are some of the top plays that you think could transpire in the second half of this year?
So, I think I'm very bullish. I'm bullish on the whole space. I'm bullish on AI. Microsoft to this point, all right, it's been a great stock. Notice how it's reacted more recently, but it's been a great name to have, and it'll continue to be a great name. I think they're making massive headway in how we're using AI, certainly in the medical space, and how that's going to help and assist not only diagnoses but ultimately treatment, and hopefully that makes massive headway, right, in terms of the industry and how it helps. But one or the other, I think going in even into the second half of the year, that you have to. This is a space you have to be in, no matter who you are, no matter what age you are. Certainly, the younger you are, you might have more allocated to it versus the older you are. But you have to be in the AI tech space, and Microsoft and all those NVIDIA, Palantir, as you said, all these names are in that space, and whether you get that exposure through the ETF or the individual name is a place you absolutely have to be in.
As you think about what we've also been hearing from what's going to need to happen on the geopolitical policy front to open up more of that total addressable market here. Even as NVIDIA has been talking about it recently, they're missing out on potentially a $50 billion opportunity. And that is dollars that they've had to essentially just say, all right, we're writing that down for right now, but we're banking on some of the intellectual property hurdles to be solved for. What should investors be keeping in mind as they're looking for some of these negotiations?
Well, listen, you have to be watching how the negotiations are going and where it's hitting roadblocks and where you think they're going to be able to discuss it and get over it or not, and that's going to kind of define it. But in my mind, I think what you're going to start to see is you're going to start to see a lot of the nations come together around AI because it is making major advancements for everybody. So none of them want to get left behind, but you do have to kind of regulate it and how you're going to regulate it, and you have to allow for companies to design and develop it. So I think the space is very exciting. I think investors just need to be paying attention to who are the biggest names in the spaces and how are they positioning themselves for that regulation.
Well, Microsoft got in early on one of those names in
100%.
OpenAI, and so that is continuing to pay dividends, at least in the exposure that some investors are looking for to OpenAI, not publicly traded right now, but one of the ways that you could get that exposure is through investing in Microsoft.
But look what Apple just did, right, with their acquisition, because they were struggling and now they just decided to go out and buy it. And I think that's actually, for Apple, it's been a great acquisition. That will be a great acquisition.
All right, we're going to continue to track this one going forward here. Everyone, on the other side of this short break, we've got all your markets action ahead. Stay tuned. You're watching Market Catalysts. Now time for some of today's trending tickers. We are watching bank stocks, strategy, and Alphabet. Let's dive in. First up, bank stocks are rising after passing the Federal Reserve's annual health check. The central bank says 22 of the largest U.S. banks are well positioned to withstand future economic downturns. This clears the way for lenders to boost buybacks and dividends for shareholders. A Fed official says that the banks are expected to announce buyback plans on Tuesday. Raymond James says the stress test results should garner increasing investor interest in financials. And Wells Fargo is naming Goldman Sachs as the big winner, along with JP Morgan, Bank of America, and M&T Bank. Perhaps should come as no surprise. Those are the largest banks and with the best positioning, perhaps, to pass some of these stress tests.
Right. So JP Morgan and Bank of America are two family favorites, and I own them. I own them both. The others I don't. But you're right. This passing of the test is going to allow investors to get even that much more confident. Once these banks start to announce these buybacks and raise their dividends, you'll see money flowing into it. And with the earnings just starting 2 weeks away, kick off with JP. All these big banks will kick off on the 15th. I suspect that we're going to hear some very positive forward guidance from these companies.
Yeah, and just a reminder, as context to our viewers, why these stress tests are so important. It essentially solidifies that the banks would have enough liquidity if there were a run on the bank. And so that's exactly why these are even more important, securitizing some of that investor interest as well.
Right, and investors should look to have those big names, exposure to those big names.
Next up, Michael Saylor's strategy is once again buying Bitcoin using common shares despite coming under fire for the practice by renowned short seller Jim Chanos. Strategy purchasing nearly $532 million of Bitcoin in the last 7 days ending June 29th. Now, Chanos is Chanos argues Strategy's business model doesn't make sense and the stock is overvalued. Saylor is arguing that Chanos doesn't understand the process here. And so maybe kind of signaling what the Sixers have told me and sold me for a while and trusting the process here. But understanding the process and the difference in strategy from formerly known as MicroStrategy, now Strategy, and of course, friend of the show, Michael Saylor, who has joined us time and time again to really walk us into what their purchase patterns would look like in the future. Very bullish on Bitcoin, and they've stayed that way and not wavered.
Look, I think everyone's entitled to an opinion and a strategy on how they design it and what they think their future is. It's okay to have a difference of opinion. Chanos thinks it's wrong. Saylor thinks it's correct. Certainly it has proven, Saylor's strategy has proven to be a winner. Yeah. So it's okay to have an argument, but I don't think you can throw all your cards in the same pile as Jim Chanos and say, oh, no, it's wrong. I don't necessarily think it's wrong at all. The world is changing, right?
It is, and it's even prompted some of the other publicly traded companies to consider where they also need to add on Bitcoin to their balance sheet, i.e., look no further than GameStop that hit the strategy button just weeks ago here, announcing that they were buying, I think it was at the time, 4,710 Bitcoin. And so we'll see how they continue to add on to a position like that. Also here, we're also tracking Alphabet's today, making a play in nuclear fusion. Now, the tech giant says it will buy electricity from a future fusion power plant in Virginia. This is power that's never successfully been used anywhere in the world yet, but the plant being built is called Commonwealth Fusion Systems and grew out of research at MIT. Fusion could help meet the demand for energy for things like AI and data centers and EVs. Google going to be increasing its existing equity investment into Commonwealth beyond the $2 billion the company has already raised here. Shares right now are down on the day, but there are always a myriad of different headlines circling around Alphabet and Google. But this is pretty significant here. And you actually pointed out another stock as well that is hot within the space this year.
Yeah, NuScale, the symbol's SMR, right? But they do these small modular reactors, right? These nuclear reactors that are really designed to help power all these things that you're talking about, data centers, EVs, and all that stuff. And I actually think that's going to be where a lot of these data centers find their energy coming from, is going to be from this clean energy.
Interesting. Yeah, and that stock that you pointed out, SMR, it's up year to date, 118%.
Yeah, it's had a fantastic move.
Absolutely. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. Well, coming up, we've got much more of your markets action. Stay tuned. You're watching Market Catalysts. According to new data out from S&P Global, stock buybacks reached a record $294 billion in the first quarter. For the 12-month period ending March 2025, buybacks totaled just shy of $1 trillion. Still with me here in studio, Kenny Polcari, Slatestone Wealth Chief Market Strategist here. So Kenny, just thinking through some of these numbers that we'd seen come forward and where we're anticipating perhaps an appetite for even more buybacks on the back of this tax bill.
Right.
What are you listening for from companies on a go-forward basis from this point?
Well, listen, you always got to pay attention to their guidance for sure, and where they think markets are going, what they think economy is going to do, where they think interest rates are going, how it's going to impact their businesses. But you're also going to listen to raising their dividends and what the buyback program is going to be, right? Are they adding to the existing buyback program? How much? And if they are, what are they adding? Where are they going with their dividends? What do they expect the dividends to be? These are all things that are going to be that investors should be listening to and should have kind of a handle on as we move into earnings season starting in 2 weeks.
Yeah, we got a comment here from Howard Silverblatt, senior index analyst at S&P Dow Jones Indices, who's been kind enough to join us on the show before again. And he says companies bulked up on buybacks in Q1 2025. Expenditures set a record level along with a stronger positive impact on earnings per share via share count reduction here. Right. And I'll pause there because this is also one of the mechanisms that you can see companies using to really kind of set more of a floor to some of the undulations or volatility, especially if they're trying to shore up confidence among investors.
In these big in all the stocks, but certainly in these big name stocks that we're talking about, right?
Yeah.
And so I think that's a positive. I think that's going to be a positive not only for the companies themselves, but it's going to be a positive for investors as they start to move more money into the financial services space, which I think is a space that's going to continue to perform.
One of the other considerations too that they mentioned for the second half of 2025, the need for shares to cover employee options. That's expected to increase. How significant of a catalyst do you think that could be in the movement that we do see, especially since we're already at all-time high levels going into and ahead of the start of the second half?
Right, but they need to do that in order to fund their employee option programs, right?
Yeah.
Because that's part of employee compensation is some employees get these options, so they need to have those to be able to allocate. Right. So look, they've had a good year. I don't know what those different what the different option agreements are at these different companies, but that's going to clearly indicate what they have to buy and how they have to buy in order to prepare to be able to do that by year end.
All right, excellent breakdown. After seeing how quickly we bounced back from the S&P 500's post-tariff lows, how should investors approach market dips here? That's another big question. And, as we're thinking about some of the pullbacks, and there had been a buy on the dip mentality coming into the year, that was alongside of and we're taking a look at the larger pathway towards these fresh records that we've been seeing. And we do know that there were a lot of retail investors that played in this rally back. What do they do now with the market at record highs?
There were a lot of retail investors that played when the market broke down in April. Because as a wealth manager, I talked to retail investors basically, right? Who were not scared off and nervous, when the market pulled back. They actually saw it as an opportunity. Now, and so they took advantage of buying at the lows. But what they're not doing now is that they're not chasing. Are they going to tweak around the edges for certain positions that maybe are now outsized based on what the market has done? Sure, but that's just risk management. That's proper risk management, what they should do. But they're certainly, as they're adding new money, they're adding new money to some of the sectors that have been underperforming versus the ones that are outperforming in order to help balance out the portfolio.
And so if retail investors were early into that and not scared to the point that you were making and the conversations that you were having, where's the institutional mindset?
Well, it was funny because it was actually the institutions that were bailing out in April. Everyone got nervous. It was the institutions.
Lowering expectations.
Right, and they were all calling for, S&P 4,500 at the year end. Meanwhile, we're kissing 6,200 right now on the S&P. And so it was actually the institutions that were bailing while the retail investor was the one saying, okay, back up the truck. And so they've proven to be right.
Interesting. Kenny, big thank you for joining us for the last 2 hours here on Market Catalyst. Your insights always appreciated.
Thank you for having me.
Absolutely. We didn't even get to talk about cacio e pepe today, right?
Cacio e pepe is the recipe today in my Substack.
All right, good. I don't know what I'm cooking tonight then. Thanks so much, Kenny. Everyone, we've got all your markets action straight ahead. Stay tuned. You're watching Market Catalysts. Americans are saving for retirement in their employer-provided retirement plans at record levels, according to a new Vanguard report. The average U.S. adult put away nearly 8% of their paycheck last year. Here with the latest, we've got Yahoo Finance's Kerry Hannon. Kerry, what's fueling this rise in saving?
Yeah, Brad, this is great news, isn't it? And if you pair that with what the employer matches, that gets to almost 12% or to 12%, which is a record high. And it's right in that 12 to 15% of your salary you should be saving that most analysts recommend. So what's really pushing this is auto enrollment. This is like across 401k plans. Employers are automatically, no waiting period, putting people automatically into their 401k plan. They're deferring them to 4 to 6% of their salary, and generally they're putting them into target date retirement funds. Then, to make it even sweeter, each year they're doing auto escalation. If the employee doesn't decide to bump up their contribution limit, they say, okay, anywhere from 1 to 2%, they're automatically pushing it up. This is super for really fueling retirement savings that fights back against, I know you may have felt it, I have inertia, feeling like you're going to make a bad investment, so you do nothing. So this is really a super change that we're seeing for retirement savers, and I love seeing these numbers.
So the report also showed more savers opting for the Roth 401k. Why is that?
Yeah, isn't it? And this again, Brad, is something it's still relatively new, but more and more plans are offering a Roth option for their employees to put their contributions aside. Now, as you know, it is not, you do pay tax on that money. It's not tax deferred, but that automatically goes into your pay, into your retirement fund from your paycheck. And so you do pay the tax going in, but you're not going to pay the tax on the growth of that investment, nor when you withdraw the money at retirement. There are some, it's very it's really an incentive that people are kind of understanding, hey, I think I'll do some tax planning for my future today if they don't need the tax deduction right now.
And so one blip in the Vanguard report was an uptick in hardship withdrawals from retirement. What does that tell you, Kerry?
Yeah, here's the thing. It's super cool that there's more people piling money into their retirement savings. This is a message we've been trying to get out there. But this, again, the withdrawals from retirement plans were at record highs, according to Vanguard last year. This is concerning. It's not a huge amount. I get that. But it's still concerning. And people who are withdrawing from their retirement accounts with these hardship withdrawals, if you're not 59 and a half, you're paying tax on that, and you're going to pay a 10% penalty, and you're losing retirement savings for your future. This is something that when Vanguard asked people why they were taking these out, it was usually for a housing foreclosure, for a medical expense, or simply in order to make ends meet. So I think it's really important to pay attention to this. And we talk about this on this program, emergency savings. People need some financial guidance on what they need to have set aside if possible.
Kerry, thank you so much. Everyone, that is it for Market Catalysts. I'm Brad Smith. Thank you for watching Yahoo Finance. We've got much more of your day's market coverage straight ahead. Don't go anywhere.